All right, welcome everyone to Value Investing Live. I am pleased to welcome back our guest this week, Bill Smead, founder of Smead Capital Management. For those of you who may have missed his first appearance, he was our first guest to kick off our Value Investing Live series back in August of last year, and we are more than excited to have him back this year. As per usual, for those of you out in the audience, make sure to post those questions and comments in the live chat throughout the presentation today and let us know where you are watching from. We always love to see our international audience members out there. Without anything further from me, I'm going to go ahead and hand things over to Bill and we can jump into the presentation today.
Great. Thank you very much. We're going to talk about value stock picking under the idea that we're just getting started in value. The markets had been very unkind to value investors until about 6 to 9 months ago. And then lately, the fears of the pandemic have brought people back to worrying about economic activity and economic optimism. And as soon as that happens, people run for the forest to try to hide. So we'll jump right in and go to the first slide and the second slide. So the thing to understand is from my 41 years in the business, this is the second great value opportunity relative to other disciplines. The 2000 bubble, the tech bubble, we didn't quite match that. And we bounced a little bit off of that. We can thank Grantham, Mayo, Van Otterloo for this chart. It's in their recent presentation. So let's go to the next one. There are an awful lot of high price to sales ratio stocks with an amazing amount of large capitalization built into them. And we like this chart that they came up with that shows the indexes inflation adjusted return the last 41 years. And then it showed the return for companies that have over a 10 times price to sales ratio. And you would have been just as well to own the Bloomberg Barclays US aggregate as you would to own expensive stocks over the last 41 years, despite how well they have done in the last 4 or 5. So you end up with a whole bunch of companies, 25% of US stocks trading at 10 times sales or greater. And let's go to the next one. And why that's so damning and why over very long stretches of time value outperforms growth is what happens to you when you're wrong. When you're wrong about a value stock, you lose about 9.5% in the next year. When you're wrong on a growth stock, you lose 13. Or an easy way to think of this is that you get hurt a lot more jumping off a 10-foot ledge than you would a 5-foot ledge. And so now nearly half of the entire S&P 500 index is trading at greater than 5 times sales, with the index at a relatively record high 2.8 times sales. So let's just leave it to be said that, in our opinion, people that are recommending the S&P 500 index now are running the risk of a minimum of 5 to possibly 10 years of poor performance because the index itself has morphed itself into being a growth stock index at a time of peak growth stock popularity. So where are the opportunities in value? Well, the first opportunity is that there are currently about 90 million millennials, and this chart indicates that they will peak out at 95.8 million strong, and the prior group peaked out at 65.8 million. So you can see there are going to be 44% more millennials living life in that key 30 to 45-year-old age demographic the next 10 to 15 years. And economic historians will tell you that that is a main driver. Having lots of people in the household formation era of their life is a great driver of economic activity. So the next chart is 3 years old, but showed what from 3 years ago to 7 years from now will be the movement of spending by millennials in the first column. Second column is the reduction by boomers, the second largest adult population group, and therefore the net growth or millennial share of growth in various industries. So the top 20 industries that will be affected by millennial spending the next 10 years are mortgage interest and charges, kids apparel, other apparel products and services, footwear, apparel and services, vehicle finance charges, other entertainment supplies, furniture, toys, hobbies, and playground equipment, cellular phone service. By the way, that's the only one with a caveat. That's just them paying their bill and having the bill assigned to them from it used to be on their parents' plan, and many of them were paying their parents. So it's not such a big spending increase. It's just moving that spending from being categorized as the parent to being them. Gasoline and motor oil, 107% increase in a 10-year time period. Household furnishings, tobacco products, vehicle purchase, vehicle rental leases, etc. Maintenance and repairs, pets, alcohol, beverages, vehicle insurance, and small appliances. So these are the 20 industries that will be most positively impacted by the aging of those 90 million millennials, ultimately becoming 95 million. If you look at the list and just ask a way of categorizing it, it's a list of necessities. And the investment markets, the common stock market in the United States, the last 10 years was a discretionary spending stock market. It was single, college educated, living in expensive coastal cities, paying 35 or 40% of income to rent, paying a substantial part to taxes, and then having discretion over what you are going to spend your money on. So Apple, every new Apple device, Chipotle burritos, craft beer, and a wide varieties of new liquors that have come on stream since then. And travel, exotic travel among millennials were very common. Those were all very discretionary. And then we went to Seth Rogen movies and laughed about 26-year-old unemployed males smoking too much pot, drinking too much, and living in their parents' basement. That was the last 10 years. And that ended when the pandemic started. Basically, we got off of that old trend, and we have now started the new trend, which leads us into this list. So let's go forward. Oil and energy is the smallest percentage of the S&P it's been in my entire career. In fact, I started in 1980 and 81. Energy was 29.5% of the S&P 500 index. It's now about 2.5%. So we think of what Warren Buffett said at the most recent annual meeting. He said the people that think we'll make a quick transition away from fossil fuels for powering cars and houses, and people that think we're never going to make a transition are both insane, I think was his term. So what is going on here is a destruction of supply of energy, and really no significant change for probably 10 or 20 years in where we get most of our energy. So we've laid the groundwork for much higher prices. I see today that natural gas is soaring in price and crude oil is approaching 70 again. We would not be shocked at all if the body politics would like to see $100 to $150 barrel oil and much higher natural gas prices, because they want to expedite the transition to alternative energy. And the best way to do that is to help those of us that own energy stocks get rich in the meantime. Another sector is in the news today. The home builders have so much demand for their product and have so much need to meet in the next 5 to 10 years that the existing supply chain problems have slowed them down a bit. But for people that have made a lot of money, like Buffett has on Apple, just think of all the slowdowns that Apple has had off and on in the last 15 years as their stock off and on soared in value. You had to be a buyer of those slowdowns. So here's the irony. Things look incredibly bright the next 5 to 10 years for the home builders, but yet the price you pay to participate with them on a price to earnings basis and a price to cash flow basis is close to the lowest it's been in the last 5 years. So the big question was, were these 90 million millennials going to be like their parents, as the Progressive commercial is trying to teach everyone, that they are going to be like their parents, which means that 60% of them are going to own homes. And if 60% of them are going to own homes, we've got an awful lot of homes to build in the next 5 to 10 years. And the next thing is the medicine companies. The medicine companies did the worst branding in the history of mankind. The first lady, Nancy Reagan, told people in 1984 to just say no to drugs. Well, Merck and Amgen and these people, they're not drug companies. The cannabis people are the ones selling drugs, not Merck and Amgen. They sell medicine, and Merck's medicine cures cancer, and Amgen's medicine cures migraine headaches or osteoporosis, or dramatically reduces high bad cholesterol among people that have tried all their other options. And those stocks are the cheapest relative to the S&P they've been any time in the last 21 years. The banks. The banks should do dramatically better because of all the economic activity created by 90 million millennials, replacing 65 million Gen Xers in the 30 to 45-year-old age group. So what you look at is spreads, credit spreads. And the credit spreads have improved, but nothing like where they'll improve to when you have a stronger economy. So here's our portfolio as of the end of June. And with that, I'll kind of stop here and open it up to questions and thoughts from our fearless leader.
Alrighty. Well, for those of you out in the audience, there was a quick run through of some of those key points for Bill. We're going to open things up now. Please feel free, poke any questions out there that you're interested in. Let us know what you want to know from Bill. He's more than happy to dive in deeper on any of those topics. Obviously, wealth of information here. So we'll go ahead and let you guys get those questions rolling. Should just take a second here, Bill. In the meantime, though, let me go ahead and toss a question at you that has come up frequently in some of our past presentations that we like to pose out there to our guests. And that is one questioning, when looking at a company, do you lean towards metrics or do you lean towards the management of a company? Do you have a preference for either one of those being good, or do you try and find a balance between the two?
Well, that's a wonderful question. So back in the early 90s, after studying Buffett and Peter Lynch and John Templeton and other great investors, we came up with 8 criteria for common stock selection. And those are all listed at our website at smeadcap.com. They're mostly qualitative characteristics like long history of profitability and generation of high returns on equity for a long time, strong balance sheet, generate high and consistent free cash flow, have a wide moat. And by the way we measure a moat and the way people try to mathematically measure moats are two different things. The moat to me are the things that defend you against competition, but there's no way to mathematically measure how much affection a Target shopper has for Target. You can drop nuclear bombs on the United States, and I think a lot of shoppers would still show up at Target every day. So we have these primarily qualitative characteristics, including shareholder friendliness, strong insider ownership, preferably with recent purchases. So answer your question, our 8 criteria has got a thing in there that says, hey, if Harold Hamm owns 80% of Continental Resources, we feel pretty comfortable being side by side with him. If Stuart Miller owns 7% of Lennar, we feel pretty comfortable being side by side with him. Or D.R. Horton, or the people at NVR, or the people that have been buying heavily in Macerich, and David Simon at Simon Property, or think of how much affection that Buffett is showing toward Brian Moynihan at Bank America. So the answer is we find these people in the process of using our 8 criteria.
Absolutely. And it does look like we have a nice little list building up here from our audience. We'll go ahead and jump into these questions now. First one coming in, asking, what is your opinion on this seemingly everything bubble in the market, if you would even call it a bubble? Has it bursted at this point? Do you think it will? Obviously, some big kind of prediction questions here, but what are your stances on kind of where we're at this point in time?
Well, we recommend a book to everyone, a short paperback from John Kenneth Galbraith called A Short History of Financial Euphoria. And this meets all the characteristics of all the great past financial euphoria episodes. So we have attempted to pivot our portfolio as far away from the financial euphoria as we can, while sticking to, ironically, one of our disciplines, which is holding our winners to a fall. Okay, so is it a mania? Yes. Is it a euphoria episode? Yeah. Yes. Do we have any way of knowing when it's going to die? No. Do we think that it's beneficial to hang in with it, attempting to get the last of the benefit? And the answer is no. We think that it will crush people that get in the way of it. If you own high price to sales ratio stocks and they have to make the transition to PE ratio stocks, that it asks the Intel and Cisco and Microsoft shareholders from 2000 whether they liked sitting through that transition and making no money or losing money for 10 or 15 years. So the answer is that we are avoiding the financial euphoria as much as we possibly can, but are thankful that value is so far out of favor that we can continue to try to create wealth in a very narrow part of the overall S&P 500 index.
Definitely. And another question coming in here, looks like a viewer from Alabama, asking for your thoughts on Disney and some of its prospects coming out of the pandemic. Looks like, in their opinion, they've seen some digital spending coming down and park and entertainment rising. Do you think it's undervalued at this point?
We have significantly reduced our ownership of Disney. We bought it in the aftermath of the 9/11 attacks originally. I did in my former business. And then we got a chance to pay. We paid about 15 then, and we paid about 15 in 03 when the Bass family got a margin call at the bottom of the bear market. By the way, a bear market bottoms when somebody that doesn't want to sell has to sell. And a bull market dies when somebody doesn't want to buy is forced to buy, people that are short. And by the way, the Reddit short squeeze people have taught everyone a lesson on how to top out a stock. So back to Disney. They've made a successful transition to streaming, but they earned an extremely high price earnings ratio for a very mature business. So we have been significantly reducing our position there, and we consider that it got caught in the euphoria in the last 6 to 12 months.
Understood. And continuing on to our next question, asking you, Bill, if you have any religion at play in your investing philosophy. Obviously, no need to dive into overly specifics, but curiosity there from the audience.
Well, first of all, a long time ago, we just kind of consciously decided that we didn't care to be in businesses that ruin the lives of their best customers. And that's not really a religious thing. That's just kind of, I begged my mom to quit smoking for 10 years, so I've never had any interest in owning cigarette companies because I don't want to sell cigarettes to a mom that there's a son begging to quit, right? Okay. Now, by the way, Philip Morris is the best performing stock of my lifetime on the New York Stock Exchange, just so you know. So I'm very conscious that that's not necessarily a good investment discipline. It's just a personal thing. It's not in our prospectus or anything. It's not extensive enough to be in the prospectus. I am a Christian, so there's no question that reading the Bible and being a Christian, that's going to have some impact on what securities you select. But the truth of it is, we've been extremely competitive the last 10 years with the growth world, without really embracing what I think are some of the worst parts of technology, and therefore it really doesn't, it's not the number one thing. The number one thing is meeting the economic need. That's our job.
Absolutely. And looks like a question from Danny coming in here, asking what you think about small caps and some of these more emerging markets like Hong Kong or Japan. Looks like valuations close to an EV to free cash flow of 60% insiders. Quality profits there, in your opinion?
Well, you went outside my pay grade with the question, the questioner, but it's a good question. I think that John Templeton, you wouldn't know who John Templeton is unless he recognized in the go-go stock market in the US of the 1960s that buying cheap stocks in Japan was a great idea. So there certainly are bargains outside of the United States, just like in 2000, most of the tech companies were in the United States in the tech bubble. So I remember Northern Telecom was 70% of the market cap of the Toronto Stock Exchange at the end of 99, because it was the only tech stock that you could buy, right? If you're Canadian, you're chasing Canadian tech stocks. There was one stock, right? So the tech bubble breaking damaged the United States much more heavily because 90% of the major tech companies were in the United States. Well, this time there's probably more spread among this than there was then, but it's still heavily concentrated. I mean, let's face it, the most glamorous and powerful tech companies are based in the United States of America. And as a sidelight, for those of you that would like to learn how we think, a book by Peter Doran called Breaking Rockefeller. Basically, Jeff Bezos did the John D. Rockefeller playbook to a T. He also ended up being the richest man in the world, as Rockefeller did. And he competed on price, as did Rockefeller. But in that book, it explains where the Sherman Antitrust Act came from and what it's supposed to deal with. And what it's designed to deal with is to stop too small a number of people from having too much power and too much success out of the total success in our society. And I think it's safe to say that we have disturbed the social order, is the way that Sherman, he said, we want to get in the way of things that would disturb the social order. I'll leave it at that.
Understood. And we have an interesting question coming in here from one of our regular viewers, asking if you were forced to invest in just one investment, you had to just pick one company, what would that one company be?
Somebody had a bug in our office. About once a year, I come in and I say, should we put everything in Amgen? So we wrote a piece, and you can go to our blog at smeadcap.com, smeadblog.com. We wrote a piece, and we compared Amgen and Merck on things like return on equity, free cash flow generation, balance sheet, price earnings ratio, et cetera. We compared them to Coca-Cola and Apple. Now, the reason we did that is because the fear people have in investing in Merck and Amgen is about every 3 or 4 years they have to create a new medicine, right? A new medicine that meets a great health need in society around the world, okay? And so that's the risk you take with them, which is, can they continue to come up with great things? But Apple is in the same situation. And by the way, I'm to this day, I appreciate Buffett buying Apple because they've got such a great hold on the customer base that when they do come out with a new thing, they're likely to get a good response. But they have that risk. They have to keep inventing great products to perpetuate this success story. And Coca-Cola has to adapt every 3 or 4 years to changing beverage tastes among the masses around the world. And right, that we went through a water phase, and now we're in a seltzer phase. Oh, and unfortunately, young people went through the energy drink phase, right? So Coke has to adapt every 3 or 4 years. So in that both Apple and Coke have to adapt every 3 or 4 years. We thought it was a very fair comparison. Amgen has as high returns on equity as Apple. Merck has as higher returns on equity or higher than Coca-Cola. Balance sheets similar, very, very similar circumstances. But both have dramatically lower price earnings ratios than those two other companies do. So the answer is that, yeah, I mean, if somebody pointed a gun at you and said, okay, you can only own one company for the next 20 years, which nobody's going to, the joke in the office is that I would say Amgen.
All righty. Well, there you go, Praveen. Amgen it is. Alrighty, continuing down our list, you did hit on a couple of these in that last answer there, but what valuation metrics do you rely upon for buying and selling stocks? If you want to get to the selling point, that's another one of our favorite questions to ask here is, how do you actually reach that point of choosing to sell a stock?
Well, let's first cover, we buy part of a business like you'd want to buy the whole business. So if you buy a whole business, 5 years down the road, what's going to determine whether that was successful for you or not is how much cash it's generating that doesn't have to be put back into the business. And secondly, what kind of return are you getting by the money you do put back in the business? Buffett always likes to talk about, okay? So that's what we look at. So Amazon goes into the grocery business. They scare the living daylights out of everybody that's related to the grocery business. And so we look and say, gee, wouldn't we love to own the entire Target Corporation? Because I happen to be related to a devoted Target shop. Okay? By the way, we're not like these hedge fund guys that pay millions of dollars for forensic research. We just talked to my wife. So that's how that works. On selling, we have 3 things that we do associated with selling. When we buy a stock new, basically for about 3 years, it's on probation. We don't know whether we're going to be right or not. And we see how our thesis develops over those 3 years. And if it doesn't work, a lot of times we'll sell and go off to another project. Sometimes we stay with it for 6 years without succeeding, like we did with Microsoft. And then a year after we sold Microsoft, they got rid of the most destructive capital allocator in the history of the S&P 500, and turned out that the new person was terrific and we never got back in, okay? Secondly, if one of our qualitative criteria goes awry with our companies, if the moat gets damaged, the balance sheet gets messed up, if the free cash flow disappears, right? If the fundamentals of the company deteriorate under those key characteristics, we'll leave the business. And lastly, as we have done with Disney, when it gets to a maniacal price, to us, it's a price earnings ratio that's doubled the norm of the prior 5 to 10 years. So if we've owned Disney at around 15 or 20 times earnings for the last 15 years, and all of a sudden you wake up and the stock's at 45 times earnings, that tells us that it's time to move that capital elsewhere.
Understood. Alrighty, and taking a peek over at our list now. Let me read through this guy real quick. So, question here, which they prefaced it as well, saying there's a big debate as to the difference of value stocks and growth stocks. And they've heard Buffett talking about this, saying that growth is now just part of the equation. Where's your stance on the differentiation between the two, if there is any at this point in time?
That's a terrific question. So the easiest and most favorite thing for us is to buy what we call a broken growth stock that we think can get back up on its horse. Okay? That's what Amgen was in 2011. That's what Target was. When American Express divorced Costco, the stock went from 98 down to below 60. That's what Merck and Amgen are right now. They're great growth companies that people doubt whether they can ever grow again. That's what we love to do. Simon Properties is the most successful owner of shopping malls and premium outlets in the United States. And people doubted them because of what the pandemic did. That's what we prefer to do. Now, something we're doing that's much more difficult, but I think going to be much more rewarding because of how much more difficult it is we believe that we're pivoting toward an era of permanently higher and difficult to deal with inflation. Because as 90 million millennials demand what 65 million Gen Xers demanded, and you flooded the system with liquidity in the 3 or 4 years prior to them wanting all that stuff, you end up with way too much money chasing way too few goods. With households having the lowest household debt service ratios and the highest savings rates of my lifetime. So people doubting economic growth the next 10 years are fighting against pretty good logic, which means higher inflation, higher interest rates, driven by home building and household formation and living life and becoming part of the progressive commercial of being like your parents. You see, 40 years ago, there was a big debate. Is it more important to have good genes or is it more important to have good upbringing? Well, when it comes to being like your parents, if they provided the genes and they provided the upbringing, the chances are pretty good that that's going to dominate your life. So we like betting that that's true. So we own the oil companies. We like to own property like suburban malls or build homes. Owning a home is the only major way that the average American household can defend themselves against inflation. They become their own landlord. They're in a forced savings program, buying and appreciating assets. When I came into the investment business in 1981, that's all anyone wanted to own was energy stocks and property investments, preferably with leverage and tax shelter benefits attached to it. So, the great philosopher John Locke talked about the three laws: the law of fashion, the law of economics and math, and the divine law. Well, the law of fashion is what governs this market. And when inflation becomes the fashion, the Investors in the S&P are trapped out. Energy's 2.5%, home builders are 0.5%. Mall REITs barely exist in the S&P, right? So go back and watch Gone with the Wind. When things get really rough for Scarlett O'Hara, what does she do? She listens to her dad. He says, go back to Tara. Go back to the land. The land is the only thing that lasts. Well, right now, people think cyberspace is the only thing that lasts. They think virtual reality is the only thing that lasts. Just go watch the movie Free Guy and you'll find out how messed up virtual reality is.
All right. And continuing, now that we've gotten in on and poked at a couple of hot topics here, we'll go ahead and toss one more at you, Bill. And do you have any interest in getting involved in any of what seem to be the currently beaten down Chinese tech stocks that have dropped off here in the last couple of months?
That's a good one. The back in November of 11 and February of 12, at the invitation of the CFA Society, they had an ongoing education series, and there were more new CFAs being produced in Asia than there was any place in the world. And so they wanted people to come and speak to these young candidates. And so I went to China and Singapore and Thailand, and I went to Korea, Japan, Hong Kong, etc. Well, by going there, I realized that we were overhyping the economic growth in China. And that caused us to be completely uninterested in commodities, okay? But secondly, someone asked me, and by the way, I disagree with Charlie Munger on this particular subject. I never want to own a common stock that the day after I buy it, the government of that company can tell me that I don't own it anymore. That's just not a risk I want and need. So the answer is, it might be a good idea, but you need to incorporate the fact that you could wake up and have nothing, right? You could just I went to bed today and I owned Alibaba. And then the next day, nobody owns Alibaba other than the government of China. So that keeps me away from those kind of things.
Well, fair enough there. It sounds like some sound reasoning as well. Continuing down our list, as it continues to pile up here, it looks like we got a lot of questions rolling in. Looking to the top of the list on our screen right now at Continental Resources, obviously we've hit in depth on why you like energy right now, but any particular reason for Continental Resources? Do they set themselves apart somehow in your opinion?
We got more oil per share relative to price per share as any stock we could buy. We got more property owned by them that they haven't yet poked holes in as the government attempts to restrict where you drill. We got an 80+% chairman, owner, actively involved in the business that wants to succeed. Lastly, for anybody that's worried about timing, go back and look at 2018 where the stock traded when oil was $70 a barrel. It's currently trading around 38, I guess. And it was trading at $65 to $70 when oil was at 70. Last time I checked today, oil's about 70. What the heck? Now, we started at much lower prices created by the pandemic, making people think that oil was going out of business completely. And then secondly, I think a lot of that spread has been the movement toward ESG, which automatically takes people away from owning oil stocks. But then we discovered something that a lot of people don't think about. And let's talk about that for just a minute. This might answer a few other questions. So there are about 8 ways to make electricity in the United States of America. The most prominent over the last 50 years were hydroelectric, coal-fired plants, and nuclear. Nuclear died on 3 Mile Island in 1979. Go back and watch the YouTube video skit on Saturday Night Live of Garrett Morris going in with a mop and a bucket to clean up the spill. That put the total kibosh on nuclear energy in the United States. Coal, as Buffett said in his annual meeting, their remaining coal-fired plants are from Pacific Corp, which they bought, and that's in the Northwest, and they're all going to get shut down. And then hydroelectric, not only are we not making more rivers and more dams, but people that care about things like salmon runs are trying to take dams off the rivers. Okay, so that's how we used to make electricity. And how you make it in the future at the moment is steam, solar, wind, natural gas, and combustion. Well, they just came out with a thing in the Wall Street Journal today that they hope to get 44% of the electricity from solar by 2050. That's 29 years. We hope to be extremely wealthy from our continental resources, from all the gasoline that powers cars until it gets replaced, that charges the batteries of the California electric cars. That's where the electricity is going to come from, is going to be natural gas and combustion, and that's what we're drilling for. So we've kind of got this game coming and going in our mind. If it's a fast transition, we'll provide a lot of battery charging. If it's a slow transition, we're going to get rich selling gasoline.
Well, it sounds like, from what I'm hearing from you, there's a lot of leeway going out into the future there. It seems like it could be some good long-term profits. Looks like next question here, taking a step back for us out of the more specifics, but looking to overall kind of ideas once again, back on the value and versus growth. Would you say that there is a catalyst for value to take over growth moving into the future, if you think it's going to?
No, it works more like a thief in the night, or Buffett likes to explain it around Cinderella at the ball. There's no clocks on the wall. She's been told that when the clock strikes 12, it's all going to turn into pumpkins and mice. And we just don't get to know when 12 o'clock is. So the answer is, and I'll say this, there is a company that just absolutely crucified young investors in the late 90s that I saw recently advertising their stock picks on one of the major business television networks. And I thought, okay, let's see. You filleted the baby boomers when they were 40. Now you're going to turn around and fillet their kids. In my opinion, that is a terrible signal for people that are buying aggressive, high price to sales ratio stocks. The same people that led the lambs to slaughter are back in the saddle again.
So we could be doomed to repeat history, as the old adage goes there.
It never repeats exactly the same, but it rhymes.
Gotcha. Well, continuing down, now that we've hit the top of our portfolio holdings here on screen, we do have a question about the bottom of it, looking at Organon. It looks like the viewer out in the audience, Raphael, has seen revenues declining over the last 5 years. What's your stance there? What do you see in it?
That's a dividend we've been given. The natural inclination during the first 6 months that people receive common stock as a dividend from one of their companies, this one came from Merck, is to sell it. Our experience is it's wiser to keep that small portion and keep an eye on the company, because a lot of times once they've got autonomy, if they have a strong balance sheet and fit our other criteria, I've missed some unbelievably good opportunities by too quickly selling spinoffs. Zoetis was a spinoff. Cognizant Technology was a spinoff of Dun & Bradstreet. We own PayPal, which was a spinoff of eBay. We've made a lot of money on spinoffs, and so we just don't want to be in too much of a hurry.
Understood. It sounds like some fair reasoning there, echoing some of our past presentations as well. Looks like Steve from Denver says, thanks for sharing today. Asking about your recent thoughts on Discovery and some of their future revenue opportunities after combining with Warner.
Yeah, I really don't prefer to be in a 6 to 9 month penalty box with a stock, but we are. No one's going to want to touch this thing until it becomes Warner Media and is all under one umbrella. That said, they meet an economic need. They are producers of superior content. They have an ability to figure out what people want to watch, and they have both national and international distribution that is extremely effective. Either they succeed together or they will become part of Apple Plus or Amazon Prime, or there's just too much great content and it's just incredibly expensive to make new TV shows and movies. You know, you're just basically throwing spaghetti up on a wall when you're making TV shows and films, and these folks are really good at it. And therefore, there's a lot of merit, a lot of free cash flow. There's a balance sheet to repair, but I think David Zaslav is one of the best people in that entire industry. And now we've made a lot of money on Discovery because we bought it first they bought scripts away from us, and then we added a lot to Discovery, and then when they got caught in the short squeeze, we sold a big part of our position. Now we've been buying back into it in the K shares because they have the same economic interest as the A shares. They just don't have the voting control that A shares have, and we're behind on the K shares. But we're way ahead compared to what we sold, the shares we sold for.
Understood. And good question here, coming in, actually taking us to the very bottom below those holdings, looking at cash. Is there a certain amount of cash that you like to hold for opportunities or that you might be playing with right now?
Yeah, we like to hold 3 to 5%. There was a great Academy Award-winning movie called Sophie's Choice a long time ago. Meryl Streep, one of her first Academy Awards. To save any of her children in World War II, she had to give up one of her children. So if you don't have any cash and a new stock comes along, you got to give up one of your children. And when you're a buy and hold, hold winners to a fault kind of investor like we are, that's hard. Selling is way harder than buying. I when it comes to buying, I know what foods I like, and when they show up, I'm happy to eat away.
Absolutely. And looking down our list here, another interesting question coming in here. Looking at the Archegos debacle, do you think that could be the canary in the coal mine for the overall market due to margin debt, mass speculation, and leveraged vehicles, being the question coming from our audience member?
There are always big mistakes being made with leverage. I was talking to somebody the other day, and they were extremely knowledgeable about one of the major hedge funds that uses a market neutral way of selling short and pairing trades and then using a lot of leverage because they're market neutral, right? So the stock market won't give them the grief. It's how good of a job they do at picking their longs and their shorts. And whereas there are hedge funds that basically do what we do, but just do it on margin. So if you'd owned our fund on margin, your returns would have been significantly enhanced, right? You'd have owned twice as much of what we own. You would have got twice the gain minus the cost of the interest, okay? And then in the hedge fund world, we would have got 2% up front and 20% of the profits and so forth, okay? So we're very content with what we're doing and don't want the leverage because that's what creates the grief when you get in difficult markets. We own companies that we would be willing to go through a battle with. We had to in 2020. We had to in 07 to 09. And that's, we own businesses that we wouldn't be embarrassed having to sit with down 30 or 40% because of an outside set of events.
Understood. And question looks like I accidentally skipped over earlier up in our list, so we can go ahead and revisit now. I'm asking if you wouldn't mind talking a little bit more about the economic multiplier of home builders and the economic impact it'll have across the country.
Love that question. So about 6 or 7 months ago, one of our favorite authors, I think actually his name is John Authors, wrote a piece, and what he said was, he's from England originally, he said Apple's market cap exceeded the FTSE 100. So then he dug into it, and what he found out was that Apple's market cap exceeded the 100 largest European companies that trade on the London Stock Exchange. And Apple's capital spending was $7 billion. And those 100 companies had $100 billion in capital spending. So here's the way I try to explain to people how the Sherman Antitrust Act might come into play, okay? So when Apple succeeds, their employees that live in Cupertino can afford to live in Cupertino because there's $15 million of revenue per employee. But they don't make what they make in Cupertino. They do all the intellectual property work in Cupertino, and they actually do the capital spending outside the country, right? The chips, the assembly, etc. But the bartender I bet the bars in Cupertino are fantastic. I bet that some of the, I just think of all the people that are showing up there to try to meet somebody that's already really wealthy. So the bartender in Cupertino, let's say the bartender's making $60,000 a year. Well, they probably live in Stockton, okay? Or the Chipotle burrito wrapper person either lives in Stockton or lives with 9 relatives or 4 college friends in a tiny apartment. There's no multiplier effect to that success. There's only multiplier effect for baby boomer stockholders. And they don't spend any money anyway. I'm one of them. I'm them, okay? So there's no multiplier effect. Whereas when all these millennials wake up and realize all we need is water and Wi-Fi, we can live anywhere. Well, when you go to these other places and you go to the bar, the bartender can afford to buy a Clayton home on a 1 acre in that town. And so, and there's homes being built, and the tradespeople show up in a new truck because they're making money, and there's tons of people that are making money. So the biggest problem is the lack of multiplier effect in the capitalization of the S&P 500 right now. And we're going to have to deal with that at some point. The combination of democratic capitalism, free country, and capitalism, it only works as long as something doesn't come along to disturb the social order. And what happens is when too much of the success goes to too few people, you end up with very unsatisfied people on the left and very unsatisfied people on the right. Oh, guess what? We're already there. You don't have to wonder. And you don't have to wonder where it comes from.
Absolutely. And as we are getting down to both the bottom of our question list and the bottom of our time, looks like we got 2 more questions here that we'll go ahead and hit on. Looking back towards those streaming companies once again, with so many streaming services coming online and everybody seemingly starting up their own, do you think we are running out of or will run out of eyeballs to actually be watching that content?
Yeah, there'll be a weeding out of those players. If you don't have the best system or the best brand attachment, or you don't have among the best content, you're probably going to struggle. Yeah. And again, you know, the cable industry has been kind of a classic value trap in that way, because they might have really good content, but they don't have scale, right? But these people that want to provide the content, they also have a problem. They got to keep coming up with content, and that's very expensive. And therefore, you know, if you own all the episodes of Deadliest Catch and 90 Day Fiance and HGTV, and you got a library there that is really attractive. So again, that's what we're interested in. If we didn't think they had as good or better contemporary content as anybody else, we'd have been long gone.
Gotcha. And as we are getting down to the bottom of our list now, looks like currently the last question we have sitting here. Looking through, looks like they are looking through the portfolio holdings and they're seeing hardly any tech names there. Would you say that tech at this point in time is intrinsically not value or doesn't have good value to it?
Well, no. I'd say, first of all, we own Qualcomm. We got into Qualcomm when it was being sued by Apple at dramatically lower prices than it's at now. But even though it's had a nice move up, it's one of the most reasonably priced of all these companies in that industry. So we have no problem holding on to it. We've had no problem holding on to Accenture for the last 13 and a half years we've had a fund. eBay is the Rodney Dangerfield of tech companies. They have the best business model in e-commerce and the lowest price earnings ratio in e-commerce. Why do they have the best business model? Because it's the New York Stock Exchange. Buyers and sellers meet there. They get paid because they meet there, and they don't do the logistics. So they earn 24.5% profit margins, and Amazon earns 5% on e-commerce. Why? Because they got to do the logistics. And let me tell you, logistics are difficult these days.
Absolutely. Well, Bill, it looks like we are running right up against the end of our time for today. I want to thank you so much for joining us once again. It's been an absolute pleasure. Thank you for taking the time to answer all of these questions from our audience.
Thanks for having us. We really appreciate it.
Absolutely. And for those of you out in the audience, including you, Mike, who arrived late, there will be a full recording of this posted here shortly once we finish up. It will be live on YouTube and live on GuruFocus as well, so make sure you check it out to get yourself caught up on anything you might have missed. Once again, thank you everybody out there for joining us. Please take a moment to like and comment your favorite parts and subscribe to the channel. We appreciate you coming, and we wish you all the best.